Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here in home studios right at the beginning of October. A lot to talk about, roughly 30 days before an upcoming election. A lot to get into today, Ez. Glad to have you back here. We took a couple weeks off with me traveling around and meeting with some customers and so forth. So very excited to be back here in home studios with, I don't know, we got to jam in 100 different things that are actually happening in the world right now into about a 45-minute show. So we'll kind of dive right into it, Ez, but I'm feeling really good about everything we're about to share with the folks here today.
Let's do it. We need some good news. We had a tumultuous morning, so let's get through it.
Yeah, some technical difficulties, but I don't know. I don't know about all good news, but we'll talk about the news and definitely provide some perspective on it. Again, if you're watching the show for the first time, welcome. Love to have you here on the Shepherd Wealth Management Podcast. Really, the reason why this has gone so well for us and for our customers that we serve across 15 states, $100 million in assets under management that we manage for them and growing, is because we provide a historical perspective on the market. Everybody that does this job as a certified financial planner manages money for other people in wealth management type of industry that we are in. Clearly, it's on the name here. It's table stakes to be able to read a balance sheet, income statement, cash flows, whatnot. Everybody's smart in this industry to that regard. Maybe not everybody, but they should be if they're doing this professionally as we are. But what gives us an edge, where our clients can find some advantage, if you will, is putting those probabilities based on history on your side. And the reason why we find that so important is human beings make a market. Well, we also know that human beings are about the most predictable thing on the planet over a long period of time. Matter of fact, you can get a PhD in behavioral finance these days. It's just a study that shows that human beings are hardwired with these emotions called fear and greed that tend to drive our decisions. Unfortunately, fear is an emotion that we all carry around. And when it comes to investing your money, people feel losses twice as much as they feel good about making a profit. So it tends to be very emotional here when we're dealing with things like volatility, election, war, natural disasters, so on and so forth. All the unknowns are reasons why investors would be worried or concerned or afraid. That tends to grip you more than it would if markets are ripping up to the upside. Of course, we all want that. That feels good to make money. But when you have all these uncertainties, that's really what drives volatility. But if you understand how human beings have behaved in previous years, decades, centuries, as it relates to the data that we have today, as it relates to the marketplace, like the S&P 500, you can at least put some probabilities in your favor and saying, okay, these are the sectors that other people found super attractive or not so attractive, given the history of the times that we're in right now. The times that we're in right now are lower inflation that's doing its cutting cycle, starting with the 50 basis point interest rate cut that we talked about in our last show. And we're also going through an election season, coming up on Q3 earnings, which are all going to be start to come out here very soon in October. We're going through seasonally a really awesome time, November, December, and then all the way into Q1. So we're going to put some historical perspective on all the things that are kind of happening right now. And that should give you some advantages in our view, at least being able to put the probabilities in your favor. Now, it's not a guarantee of any success at all. It has certainly worked for our customers here at Shepherd Wealth Management, but it is not a guarantee of success. Past performance is no guarantee of future results. Investing, of course, involves risk, including the risk of loss. So with that being said, as we're kicking off the show here today, equities did sell off sharply in October, with the S&P 500 down approximately 1%, NASDAQ 100, Russell 2000. All of those were down roughly approximately 1.5%, kind of to start off the month here in October. Now, for whatever the reason, this has been a great year for equity investors, with the S&P 500 up about, called approximately 20%. But for whatever the reason, as strong as the market has been overall this year, 2024 has had a pattern to it, in the sense that 6 of the 10 months so far have started out with a decline in the first day. And of course, we're still in the midst of a very challenging few weeks here from a seasonal and historical perspective. When we're talking about election years, we're roughly, 30, 31 days, something like that, away from the actual election. So all of this volatility certainly is providing opportunity for a lot of investors that can put some of this historical stuff into perspective. And what I mean by that is there's a ton of cash still on the sidelines. We'll talk more about that here specifically. But I think a lot of the other headwinds that we're going to dive into right now are really what's holding investors back. So, of course, we know the election's coming up. But right now, there are kind of three big headwinds. One would be the strike that we're seeing across all the ports, or most of the ports here, east and west coast of the United States. And that's a concern. Obviously, it should be a concern for investors. Why? One is it certainly could affect the jobs data, and unfortunately, when we had a natural disaster in Texas earlier this year, caused a couple million Texans to be without power. The businesses were out power for a couple weeks. And when the jobs data came out, well, nobody in the news actually said, "Hey, the Bureau of Labor Statistics didn't actually account properly for, the jobs that were lost essentially over those couple weeks, right?" And then everybody sold their shares because they were like, "Oh, the Fed's waited too long to cut interest rates, and now they're going to tip the U.S. economy and the jobs market into recession." Of course, that didn't happen. Markets rallied and recovered all those early losses. Um, and now we're coming into some jobs data tomorrow, which won't have any impact. There won't be any number impact relative to what's going on, down in Florida with the hurricane down there and how that's ultimately affected a bunch of people in North Carolina as well. That's not going to show up in tomorrow's data, but it certainly would show up in next month's jobs data. So hopefully that's more clarified by the time that does come out. And of course, people not working here because they're on strike, that could also show up in next month's data as well. So don't be surprised if you see some, distortions in the jobs data as we get into the month of November. Now, secondarily, headwind, which is really nothing that we have any insight on, but it is something that's certainly in the news and would cause some concern for investors. That would be the Iran-Israel conflict, and certainly nobody wants to see anything like that. I don't want to see what's happening in Ukraine either. But this is just part of the world that we live in, and if you're a investor, there's really nothing that you can do to really protect yourself, if you will. I mean, yes, you could buy put contracts or buy a whole bunch of security through things like treasury bills and whatnot. But essentially, if you're a long-term investor, this is just a part of being a long-term investor. I mean, there's been conflict on some place on the planet for pretty much all the time. So there's no real great way to go about diversifying that risk. It's just something that you're a part of over the long haul. But what we also know is those conflicts tend to provide opportunity as well for the long-term investor that can keep their cool. And that's part of the reason why we provide all this historical data, is not just to put probabilities in our favor. Yes, that's important from a performance standpoint. But again, if fear is the thing that grips people more than making a profit, well, the best way to control your temperament or your emotions is to get an idea of, well, what does history have to say about this? And if these things were to happen, well, what were the other outcomes under very similar circumstances? And of course, we have access to all the data these days. And it's just getting easier to get it, given the way that things are with ChatGPT, artificial intelligence, etc. And the last one is October seasonality, specifically for an election year, is kind of a coin flip. It's about a 50-50 chance, roughly, that October would be positive during an election year. And if it is positive, it would be positive roughly about 2%. But I have some additional data here to share regarding October here in just a second. Now, one of the things that I wanted to mention that I haven't really heard at all in the news before we start to get into some other historical data points is the U.S. 10-year Treasury has barely moved. Now, oil prices kind of spiked for a day, called a day and a half. I wouldn't call it exuberant. I wouldn't call it outlandish. I thought it was about right. Oil being up just a little bit, but nothing dramatic like you would expect with a conflict like what we're seeing in the Middle East. So that's kind of good news. We're not seeing oil just run away and everything else selling off in a panic type of move there. So that's something to keep an eye on, of course. But the 10-year has not, I mean, it's barely moved at all. And that is also a good thing. I view that the bond market is usually a little bit ahead of the stock market as it relates to a lot of volatility. And you're just not seeing people, run to safety out of nowhere. So typically, if everybody's very very fearful, they're piling into things like the 10-year Treasury. Well, generally, you're going to see those rates come down, and that 10-year has hardly moved at all. And if anything, it's gone up in rate just a little bit, but nothing dramatic at all. So haven't heard a lot of people talk about that. Definitely something I wanted to mention to the audience here today. But as we get into some of that October seasonality data, here's where I wanted to kind of really kick things off here from a historical perspective. First of all, you have year to date, again, the S&P 500 right around 20% to the upside. That is the ninth best start since 1950. Now, looking at the 10 best starts through September 30th since 1950, 7 of 9 saw declines in October with an overall median return of negative 2%. So as I mentioned, when you look at October just from a big macro, 100 plus years worth of data, it's kind of a coin flip whether or not you're going to get positive return on the S&P 500. But when we look at the data in this lens, ninth best start since 1950. Of all the 10 best starts since 1950 through September 30th, 7 of 9 saw the October month being down approximately 2% on the median. And so our base case here for investors is the market's going to try to tread water throughout this month. And we've talked about all the reasons why people could be concerned and worried given the election that's also coming up here. It wouldn't be too surprised if we're kind of churning sideways, maybe slightly to the downside. So how would you approach this? Here's how we're approaching it for our clients at Shepherd Wealth Management. We love and we like to invest in individual stocks. Certainly been something that we will continue to do, something that we have done. But why take on individual company risk with all of this volatility that we're experiencing right now? So to us, the way that you can play this is instead of using individual stocks in this moment in time, pre-election, pre all these worries, pre all the seasonality data just provided here in October, you can't just sit it out. And the reason why you can't just sit it out is exactly what happened in September. So September, we got off to the fourth worst start in the history of all market data for the month of September. September was down 4% in the first couple of days. Right, a lot of that had to do with the jobs thing I just referred to just a couple minutes ago. Now we got all that back. Now just to put all that in perspective, when September starts out negative 1.5% or worse, just like it did, 0 of 20 times, there's been 20 instances where that's happened over the last 100 years. 0 for 20 was September positive. Well, September was positive this time. So last month just bucked 100 years worth of market data. Okay. You cannot just sit it out. Now, the probabilities were in your favor if you did decide to sit it out. Matter of fact, once we got the rally back for our customers, we took a significant position in cash. We weren't 100% cash by any means, but we did take those profits. We tried to protect them by sitting in cash. And yeah, we probably missed out on about 1% over the back half of September. But hey, the probability said that was the right thing to do. Wouldn't really change the decision. Hindsight is certainly perfect, being 2020. But literally September bucked 100 years worth of market data. So you got to go into this, understanding that you're not going to time anything perfect, and history does not have to repeat itself sometimes. Okay, so that's just a little disclaimer out there for you guys. But this is the ninth best start for a S&P 500 since 1950. And of those 10 best times through September, 7 of 9 saw October down. Again, a median negative return of 2%. So how would we play this? Again, I don't really feel like it's prudent to take individual company risk given all the reasons to be concerned as an individual investor right now. So the way that we like to do this is by using exchange traded funds or ETFs as the primary vehicle that we're going to invest in, but we're not taking 100% positions. So we have certain sectors of the market we really like in an interest rate cutting cycle that would certainly involve small caps, industrials, financials as the primary asset classes that we really want to have some exposure to. In addition to that, we also want to have some exposure to home builders as interest rates are coming down. But we're not taking full 100% weighting. So if we wanted to have, let's say, 10% in a home builder, right now we're probably going to start out around 3, 4, something like that. And the cash that we have on hand, given what we know about October's seasonality, going back to 1950 and all the data I just provided. We can't time it perfect. We don't know for sure if history will repeat itself, but what we do know is the probabilities would favor volatility. And I think given all the reasons, news media is just going nuts these days, I think it would be prudent to take your positioning in those sectors and then using the cash to slowly dollar cost average. So again, we're about 5 weeks away from the election. Well, if 50% of your money is in those positions, however you want to weight them, well, that other 50%, you can literally go and say, okay, I'm going to take 10% every Monday or pick a day of the week, 10% over the next 5 weeks. I'm going to dollar cost average into all these positions that we really want to have exposure to, given, rate cutting cycle, really strong labor market, really strong corporate earnings, et cetera. We are very bullish and very excited for the back half of Q4. But the front half here in October is going to be potentially volatile based on what history has to say. So that's the way that we're looking at this. And the best way to go about managing risk would be to take the opportunity that the market's giving you with some of this volatility. And just know that you're not going to pick the perfect price on all those positions on any one given day. And dollar cost averaging is a great way to go about minimizing your inability to perfectly time the bottom of any one of those sectors or any one of those positions. Now, after we get through the election, some of this uncertainty hopefully goes away. Now we can start to maybe look at, okay, depending on who is actually in the White House, there will certainly be some sectors that benefit more than others. Now we can potentially go and reducing some of the ETF exposure and go with company specific within those sectors. So that's the way that we're looking at it here for our customers at Shepherd Wealth Management. Now, speaking of volatility, there's also something that isn't talked about very much in news. It is a little bit from time to time, depending on the programs that you're watching. But there is something known as the VIX, which is a volatility index, of course. And we want to look at the term structure of the VIX. And what I mean by that, you want to take the 4-month forward VIX minus the 1-month futures. And of course, if the numbers are spiking, that would generally mean that there's more volatility coming up over the next month as opposed to 4 months out. And that's generally the case here pre-election. The VIX has spiked. It's roughly around 19. And that means the 4-month VIX, which is January, has a lower level than the 1-month VIX right now here in October. So markets see near-term risk. Now, when this uninverts, obviously it's more of a risk-on type of appetite. So again, based on history, markets are starting to price in some of this volatility through this VIX term structure. And that's exactly the reason why we want to take advantage of that and dollar cost average into some of these sectors and asset classes that should perform past this election and continue the rate cutting cycle. Because literally right after election day, Fed is making an announcement on what they're going to do with interest rates. Is it 25 basis points like Powell talked about just a couple of days ago? He mentioned doing 25 in November, 25 in December. They'll probably keep on that similar lowering of rates into 2025. But we're going to get a lot of data here. It certainly could make him more dovish, kind of given some of the geopolitical risk. It's possible he might want to do 50 basis points again. So we're all going to have to sit back and watch. Now, in addition to not just the U.S. economy lowering rates, you're also getting an impact from China. So China is doing absolutely everything they can from a stimulus standpoint to kind of fix their economy. Basically, on a 3-year and 10-year basis, China has massively underperformed the U.S. stock market. I mean, on the 3-year underperformance versus the S&P 500 is minus 34% for China. That's the worst. Was the worst. And on the 10-year underperformance for China's market relative to ours, it's minus 77%. So China is really trying to take aim at their economy and boost it by providing a bunch of stimulus. We'll see how that works out for them. Hopefully, they're not going to deal with things like inflation, like we have here. We had a bunch of government stimulus kind of on the back of COVID and all the supply chain issues, of course, spiked inflation as well. So there's a lot of reasons for that. Wasn't certainly one reason. But we'll have to keep an eye on that. But if you can get a Chinese economy, which is, of course, the second largest economy on the planet, to actually start to play and grow along with the United States, now you've got some serious tailwinds to get pretty excited about going into next year. Of course, a lot to do between now and next year as well. In addition to all of that, there's still a ton of cash on the sidelines. Matter of fact, this balance of $4.2 trillion of cash, that's how much cash we had when the Fed began its war on inflation and started to increase interest rates. Today, the total money market balance has surged to 6.4 trillion as of last week. It's up a record 130 billion since really the last time we provided this stat. I mean, we were hanging around $6 trillion of cash for the majority of 2024, and that number has increased by about 130 billion here as of recent. Given all the things that we just led the show off with, port strikes, natural disasters, geopolitical risk, got an election coming up here. Still trying to figure out what the right um, monetary policy is. Do we have a strong jobs market? Absolutely. And you saw jobless claims today, barely moving. Now we're going to get a big jobs report tomorrow, so that's definitely going to be a market mover for sure. But I expect it to come in right around what economists would anticipate. Could it be a little bit lower, a little bit better? It's very possible. But I think strong numbers, I think good news is now good news. And bad news is bad news in the market. So if you get a really good jobs print tomorrow, markets kind of take off. You should just kind of take that and say, okay, when we get good news in the marketplace from a macroeconomic perspective, when we get good news from corporate earnings, take it as it is. It's good news. Let's put that to work in those asset classes. And of course, the opposite would be true. Now, last thing that investors are trying to top call the market, being up 20% right before the election. Margin debt is something to keep an eye on. And this has not even risen in the last 4 months. It's basically been flat. So right now, margin debt is around 797 billion. And please keep in mind that this figure was 936 billion in October of 21. And that's where Jerome Powell started to fight inflation in a very big way. So we're still a long ways off from people getting so excited about the prospects of future growth in the stock market that they're willing to take on leverage, margin debt, and place their bets. So we're pretty far off from the last time that we peaked. Now, what does all this really mean? Well, keep in mind, since 1950, when the S&P 500 is up 10% in the first half of the year, just like this year, the second half average gain is just under 10% with an 83% win ratio. And this would imply the S&P 500 reaching 6,000 or higher by the end of 2024. And right now, as I'm sitting here delivering this podcast, the S&P 500 is sitting right at about 5,700. So it's about 300 plus points of upside potential if history should average out what it typically would since 1950 when the S&P 500 is up more than 10% in the first half of the year. Now, all of the things that we just talked about, they're really just helping you put things into perspective. If you do get more volatility, you should expect investors to come in and buy any volatile dip that you see. I think that's why you're kind of going to see the market trading sideways, given how much cash is on the sidelines between now and election day. With all the data that we've talked about, though, nothing, of course, is a guarantee in any way, shape, or form. But the one thing that is true, and you are hearing professionals talk about, shows like CNBC and Fox News and CNN, they talk about a market being expensive. Well, I would actually just call out the fact that yes, if you just look at the S&P 500 as it is right now, you would see a PE multiple of about 21, 22 times. That is a little rich given the S&P's history. However, we have massive tech companies in the United States stock market being the S&P 500 that other countries are extremely envious of. I think China would love to have, NVIDIA being a Chinese company, as an example, or India would love to be, the home of Amazon. That's just not the case. Those companies are traded, they're U.S. public companies, and they're the best on the planet. They deserve a richer multiple given their cash flows and prospects for future growth. If you strip out those 7 companies, I think we all know the names of them, so we don't need to rattle them off. If you strip out the seven biggest tech companies from the S&P 500, the forward PE multiple in the S&P 500 is actually 16, which is right at the historical average for the S&P 500. So is the overall market rich? Not so much. I mentioned small caps many times here, and a rate cutting cycle tends to historically be the best performing asset class over a 3, 6, and 12-month period of time as the Fed starts to cut rates just like they did a few weeks ago and will continue to do as we reach November, December, and beyond. If you look at the small cap valuation from a PE perspective, right, try to compare apples to apples. Now, these are much smaller companies. These are companies valued between $1 billion and $5 billion. So they are much, much, much smaller than companies like Apple and Amazon, et cetera. But they are publicly traded. Now, those small cap companies' PE, as of today, is right about 13 times. So way undervalued relative to really small caps from a historical perspective, but certainly much more attractive valuations comparing that to the S&P 500. Now, you can't just look at something like a PE ratio and say, okay, I'm only going to buy the things that are quote unquote undervalued relative to their history. You can try that. That may or may not work over a long period of time. Let me know how that works for you if that's what you decide to do. But if you're just going to look at valuations and then come to the conclusion that the small caps based on historical trends when the Fed's cutting rates perform well, they are much more attractively valued relative to the S&P 500. Well, here's another little nugget. If you break out the S&P, so if you break out the small cap, we use the Russell 2000 index. The ticker symbol is IWM. In that index is roughly 2,000 small cap companies. And about 37% of those smaller companies are smaller financial institutions. These are regional banks, community banks that are publicly traded, et cetera, across the country. It's about 37% of those. And as interest rates come down, well, loan demand goes up. And we already know, and this is the simplest way that you guys can wrap your mind around this, we need about anywhere between 6 to 7 million more homes than what we have here today in the United States. And if you're a home builder, regardless of where you're at in the country, in the United States, you're likely going to finance those build outs in California, Texas, Arizona, whatever, at a local community bank. So again, loan demand will go up as interest rates are coming down. I've lived in my neighborhood here in Northern Kentucky since 2013. They have not built one home until just right now. They're building 3. They're almost done as we speak. And they've cleared out God knows how many acres of land where they're going to connect a much larger subdivision to ours. It's not a coincidence that you're doing all this right now. Okay. Home builders know that rates are coming down. The Fed's already told you that. Rates will normalize somewhere eventually. By the time we get to the end of 2025, going into 2026, I'd be willing to come back and look at this exact same show and say, hey, we'll probably find rates being around 3.5, maybe as low as 3. And home builders are completely aware that there's a massive amount of demand and not enough supply. So as soon as it becomes more profitable for them, and it does become more and more profitable for them to finance these build outs as rates are coming down. Generally speaking, home builders are paying an interest-only loan, right? Because they got to build this thing. So they're going to get zero cash flow, just a ton of expense, right? Until they can actually finish the product, find a buyer, and sell it. That is 37% of the small cap index, okay? There's another approximately 13% that's going to make up some biotechnology type of companies as well. And all of those companies, it's very, very expensive, just like it would be for a manufacturer to make, a car. Very, very expensive on the research and development of things like any sort of drug, any new drug like the weight loss drugs that everybody's raving about these days, et cetera. It costs a lot of time and a lot of money. They have to finance these operations. Again, as rates come down, it just makes it more profitable. The smaller manufacturers that make up the Russell 2000 index, those will all benefit as well. And in addition to that, of course, if you're getting lower interest rates, it's not just helping small financial institutions, it's helping larger ones as well. It's providing more confidence for CEOs to make investments. All of this stuff boils up and provides an opportunity for investors to really take advantage of what will most likely be a really good S&P 500 move post-election. I mean, it's just, you look at anything from a historical election year, right after election day, regardless of the outcome, of the election itself, if your favorite candidate does not get picked, do not fret. Okay, there will be some sectors in the S&P that benefit more than others, depending on who's in the White House. I will grant you that. But if you look at what the S&P 500 does post-election, it's not 100% true. You can't just say this is a blanket type of performance that you're going to see, but people understand that that uncertainty has been removed. And they're also going to know, if so and so person gets in the White House, well, is the Senate and Congress basically at a gridlock, meaning that that candidate really can't push forward a lot of the agendas that they'd like to pass. Once the market has a clear perspective on that, well, they already know where rates are going, just like home builders do. Now you would expect the market to get really excited, want to take on some risk, and that meaning they want to put some money to work in equities. So we're kind of putting ourselves in a position, knowing that we're going to get some volatility in October, knowing how to take advantage of that through dollar cost averaging. We should put ourselves and our clients in a position to win. Will we beat the S&P? Well, that's going to be based on how much we're overweighting these sectors, and if we're getting that overweight correct, and we're going to use history as our guide to do that. And therefore, I think a lot of opportunity will be available for those that are going to be longer term investors and participate within the equity market. So this has been really the messaging. So we're in October. This is the beginning of a new quarter here at Shepherd Wealth Management. We pride ourselves in sitting down with our customers every single quarter, whether that's in person, on the phone, via Zoom, going over not just the data that we're providing you here today. Of course, we will reiterate all that, but not just to say this is exactly what we're going to do, but to also gauge kind of their thoughts and feelings on all this. Most people, when I sit down with them, I mean, the first question is, well, what's going to happen to my money if so-and-so wins the election? Well, what's going to happen if we actually get into a bigger conflict in the Middle East? These are the types of conversations I want to have. I don't know exactly what's going to happen in any one of these instances. I have no idea when the port strikes may end, but I can put some historical precedents around all this and at least give some ideas as to what the probabilities might look like. And that's what drops everybody's blood pressure. At least there is a precedent that we can look back to and say, hey, these are the odds. And here's how we want to play those odds, knowing you as the individual client, your individual risk tolerance, and the goals that you have for your specific money. And I hope that if you're listening, you're doing this internally for yourself. And if you've hired somebody else, like a big company, to manage your portfolio, I hope that they're willing to take the time and interest in you to be able to accomplish very, very similar things. So this has been hopefully a very good, informative, a lot of data, a lot of historical information here to digest. But this is the type of place where you can find this information. And unfortunately, it's not really in the mainstream news on a daily basis, but this is exactly what has provided our clients with an edge and certainly given me a lot to be excited about in the face of what could be a whole lot of worry for those that don't have this information or don't have the time to do this given their job or kids or whatever there is. So please subscribe to the show if this is something that you've enjoyed. We'd love to receive your questions as well. You can find us at shepherdwm.com. Again, my name is Joshua Casey Garland, Certified Financial Planning Professional, founder and CEO of Shepherd Wealth Management. Wishing you guys a great rest of your day, great start to the month of October here. And we'll be doing this again in just a couple weeks. Hope you guys have a great rest of your day.